Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to cash receipts, cash payment schedules, and cash budget. Get ready, it's time to take your chance with Corporate Finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into our worksheet, into our schedules on the right-hand side, including the cash receipt schedule, the cash payment schedule, and the cash budget. We do obviously need to go in order. In other words, we need the schedules up top, the cash receipts and payment schedules, before doing the cash budget. Our focus will be on the months of June, July, August, and September, but we will need the activity for April and May in order to do so. We're going to put those into our schedules so that we can make the copying and pasting of the formulas within them easier to work with. So we're imagining here then that April and May has passed. We have the actual data there. We're projecting into the future for June, July, August, and September. Information on the left, we have the actual data for sales and purchases for April and May, forecasted data for sales and purchases for June, July, August, September, and then we have the percent of sales for cash, meaning of the sales that we made. In this column, the amount for cash was 40%. That means the credit the sales that we had, meaning the amount of sales we made that we didn't receive cash for but went into accounts receivable, would be the 60%. Of the sales that we're going to say are credit sales, we sold them on account, they're going through accounts receivable, percent collected in the month after the sale, we're going to collect 30% of those receivables in the month following the sale that took place, and then 70% is going to be collected 2 months after the sale. That 70 and 30 adds up to 100% of the credit sales that we're going to be making. Percent of purchases paid in the month after purchase, so now we're talking about the purchasing items when we purchase materials. We have the percent of purchases paid in the month after the purchase will be 40%. These are going to be the items going through accounts payable. We purchase them, don't pay cash, but put it into accounts payable and then pay for them 40% after the month in which we actually purchased the materials. Then we have the percent of purchases paid 2 months after the purchase. So that means we purchased it on account, and then 2 months later, we're going to be paying for it, the actual cash leaving for the items, materials we purchased prior to that and put into accounts payable. And then we have the labor as a percent of sales. So 25% will be the percent of sales for labor. Overhead per month is going to be fixed at $12,400. Interest payments due June and September are going to be the $31,600. That's when we're paying the interest payments. Dividends we're going to be paying out. That's going to be taking some of the revenue earned in the company, paying it back to the owners. That's going to happen in June, $51,400. Tax payment to be paid June and September. So we're going to be paying the tax payment, the $25,300, and then the capital purchase layout for September, meaning we're going to buy something like a building or equipment that's going to have a large capital layout, taking money for that particular large investment, the $300,000. So then we have the ending cash balance for May, $21,500. We also have a minimum desired cash balance of the $10,000. So if we dip below that $10,000, we're going to take a line of credit, basically a loan, to pick it back up to that $10,000. We also have a maximum desired balance of $50,000, and if cash is over this amount, will be used to purchase securities. Marketable securities will be sold before taking out a loan. So you can see what basically is going to happen is we want to build up our cash so that we can pay for this capital expenditure. But as we are doing that, we don't want to just keep it in the cash account. We would like to put money, if we can, into securities because we're more likely to get a better return on investment. And then once we have a payment, which we're assuming is going to be this large capital expenditures, we will then sell those securities in order to pay for that, and then possibly, most likely, take out a loan at that point in time as well. All right, let's scroll back up. Let's do this thing one thing at a time. We're going to start with the cash receipts schedule. So cash receipts schedule, we're first going to be thinking about the sales, because the sales are going to be what we're going to base the receipt schedules on. So I'm going to put this information in. Some of these sales will be credit, some will be cash related. I'm going to be in April. We're not going to be doing the receipts for April, but we need this information so that we can then calculate the receipts that will be gotten in June, July, August, September for things that happened in April and May. So I'm going to say this is going to be equal then to the sales item. I'm going to say tab, and then I'm just going to do this all the way across. This is going to be equal to the sales. These are the actual items that actually happened. Remember, in our mindset, these ones in red, April and May, that time has passed. and we're budgeting starting in June. So these are going to be our budgeted amounts here. The expected values are going to be the 307, and then July, the sales expectations are 308, and then we have August, the expectation 321, and then September, the expectation the 361. Then we're going to be figuring the credit sales, the sales that we make on credit versus the cash sales. It says here that the cash sales are 40%. So then the credit sales are going to be 1 minus the 40% or 60%. I want to do that with a formula. So I'm going to do that this way. And I want to use this item here. I don't want to hard code within the formula. I'm going to say this is going to be equal to the sales and then times brackets. I'm going to say 1 minus the 40%, close up the brackets. We want to do that because that will allow us to pick up this number over here. And then if we want to change our data in the future, we could just simply change this number. And that's really useful for our projection purposes. I want to copy this across, but I don't want this 40% to be moving. Therefore, I'm going to make it an absolute reference, putting my cursor between or in C10 and selecting F4 on the keyboard, putting a $sign before the C and the 10, enter. Then we can use our autofill feature, clicking back on it, putting our cursor on the fill handle, dragging on over through September, double clicking on September to check if it's doing what we want. Looks like it is, so that looks good. Then we're going to have the actual collections that we will have. These are our cash items, so the cash receipts. These are the receipt items that we will be looking into here. We've got the credit or the cash sales first. Now the cash sales can be calculated then, and I'm going to start over here in June, because we only want this information up top for the data purposes that we will then be needing for our forecasted items. So I'm not going to put the cash sales in here for April and May, but rather start in June. And we could then say it'll be equal to the 307 minus the credit sales. That's one way we can calculate it, and we could copy that across very easily. Or we could take the sales up top times the 40%, which is the percent which was for cash. And if we do that, double clicking on it, we can then try to copy this across. Once again, not wanting to change the cell, therefore making this an absolute reference, putting our cursor in C10, selecting F4 on the keyboard, $sign before the C and 10, and enter, putting our cursor back on it, autofill handle, dragging that autofill handle over to September, double clicking on September to make sure that it's doing what we expect it to be doing. It is, so we are good there. Let's go to the 1 month after the sales item, meaning we're looking at the credit sales now. The credit sales are happening here. They're going into accounts receivable. We're going to be receiving them, getting the cash then. We're looking into those components that we'll be getting 1 month after those credit sales took place. Credit sales here, the 199, 200, then in May, then are going to be received for in part in June. So that's why we had the April and May data. So we're going to be picking up then those credit sales. We're going to be multiplying that times the sales percent collected 1 month after, which is going to be this 30%. And I would like to make that an absolute reference because I don't want it to move as I copy and paste this from June to September all the way through. Therefore, I'm going to be in C12, select F4 on the keyboard, making it an absolute reference with a $sign before the C and 12 and enter, putting the cursor back on it, autofill handle then, dragging that autofill handle to September, double clicking on September to check that it's doing what we expect it to, that being taking the prior month times that 30%. So then we're going to do 2 months after the sale. So we're going to say, all right, that's why we have this April data here, because 70% of the sales that we're going to receive, it looks like we're collecting 2 months after the sale, which is kind of a lot. We'd like to be able to kind of collect a bit faster. We could probably work on that. But in any case, that's the way it is. That's what our projection is doing here. So we're going to say 2 months after. That means in June, we're picking up the April sales on credit sales, times, and then we want to pick up this 70% here, 70%, and once again, I'd like to copy this across, but I don't want that 70% to move when I do so. Therefore, we are going to put a F4 or select F4 and put a $sign before the C and 14, enter, put our cursor back on that cell, put our cursor on the autofill handle, drag that on across. Once again, double click on September. It looks like it's doing what we expect. It's taking the 2 prior months to July, in this case, times the 70%. The 70% didn't move. This cell did move. That's what we were hoping would happen. And that's what did indeed happen. And then we're going to have the total receipts. Total receipts, we can go then and sum this up now. Trusty sum function equals SUM, shift 9, up arrow once, holding down shift, up, up. And there we have it. We don't really need to close it up now. You could close it up, but it's not really necessary if you just have the sum function. And there we have that. Let's go ahead and format it first and then copy it across. I'm going to put an underline here. Let's put an underline on all these. Put an underline on all these. Home tab, font group. We'll go ahead and underline that. And then I'll put a double underline here and then copy it across. So we'll go to the home tab, font group, drop down, double underline, because that's the bottom line. And that gets a special double. So then we're going to go ahead and autofill this across. And there it copies with the double underline. Double click it on the last one. It is doing the sum function, which is what we wanted it to do. So then we're going to go to the cash payments schedule. Cash payments schedule, next item. We're thinking about the materials causing us the most problems because the materials purchases that we purchase typically will then go through accounts payable, which has that delayed or staggered feature once again. So if we think about the material purchases, they will be up top here. We have the actual purchases and the expected purchases. These are purchases that may have been made on account. They're going to be having made on account, meaning we purchased but we did not yet pay for in these items. And then we'll think about when we actually paid the purchases. So when we purchase, they go through accounts payable and then we pay them. So I'm going to say this is going to be equal to, I'm going to scroll on over and pick up the 147. I'm selecting tab on the keyboard, and then May is equal to the 136,000 tab, and then June is equal to the 137,000 tab on the keyboard. July is going to be equal to the 196 tab on the keyboard, and then August is going to be the 216 tab on the keyboard, and then September is going to be the 201 and enter. So now we're going to be moving to the payments. These are going to be the cash outflows. We're going to start out with those cash outflows related to the materials, So we're going to say that this then will be materials that we paid for 1 month after the purchase. That's why we have the April and May here, because even though those time periods have passed, because we're going to be paying for those items in the time period that we will be covering, including June. So let's do that now. We're going to say, all right, this is going to be equal to the June payments, going to be picking up that 136 times, and then we've got the percent of purchase paid in month after purchase, and that's going to be the 40%. Now, when I copy this across, I want to be able to just copy this across. Therefore, I need an absolute reference. So I'm going to select F4 on the keyboard, $ before the C and 16, and enter. So there we have that. Put our cursor back on it. We're going to get the autofill handle and then drag that on over to September. Double click on September, and it is picking up the prior month, and it's picking up the proper amount in terms of the percent. So that looks good. Let's go then to the materials that we're going to pay for 2 months now, 2 months after they have been purchased. So that's why we have the April data. Notice we're not putting the information here for the materials that were paid for in these items, because the only reason we have this data is in order to populate the payments necessary in an easy way so we can copy and paste the formula across in our worksheet. So now we're going to go to June, and we're going to say we're still paying off some of the purchases that took place in April. We'll take that 147 and multiply that times. Now we're going to be picking up the 60%, which are paid 2 months after the purchase. We want to make that an absolute reference so that it will not move when we copy across. Therefore, I'm going to select F4, put in a $ before the C and the 18. I'm going to start using the keyboard to copy this across just to practice something different. So I'm going to say Control C on that cell, right arrow, holding down Shift, right, and then Control V on the keyboard. Double clicking on the last one to see if it's doing what we want. It is taking 2 periods prior times that 60%, so that looks good. Then we're going to move on to the labor. So labor is going to be the next item. So I'll just type that in, labor, and that is going to be 25% of the sales. So we have the sales up top. Sales are here at the 307. So for June, so let's use that number. I'm going to say this is going to be equal then to the 307 times, and then I'll times that 25%. Now I want this one to move as we go, but not this one. Therefore, I'm going to make this an absolute reference by selecting F4, $ before the C and 19, enter. I'm going to use the keyboard to copy it across. So I'm going to say C or Control C, right arrow, holding down shift, right, control V, double clicking to make sure it does what we want, picking up this number times the 25%. That looks good. Then we're going to move to the overhead. That one is a fixed cost of the 12,400 for each period. So I'm just going to say equals. We'll pick up that 12,400. I want it to stay the same when I copy it across. I'm just going to say F4, enter, put our cursor back on it, control C, right arrow, holding down shift, right, and then let go of shift, control V, double click on it to make sure that it's doing what we want. We're picking up that one number, so that looks good. Then we have the interest. So the interest is going to be paid on June and September. So we're going to say, all right, June and September. So here's June. We'll pick up the interest here, and September. We'll pick up the interest there. Now, remember, this is going to be different than what you will see. Did I pick up the proper interest expense number? Yes. No, this is going to be different than what we will see on the income statement, because on the income statement, the interest will be allocated to the period in which it was consumed in order to generate revenue. So this is cash flow. It'll be different on the income statement. So be aware of the difference between the cash and accrual method, basically. So then we have the dividends that we paid, and it says we paid dividends in June. So we'll just go to June here. Dividends are going to be paid in June. Now, the dividends are not on the income statement at all, because that's not a performance number. It represents the money that we have accumulated and then decided to give back to the owners in the form of a dividend. And then we have taxes. So taxes, we're going to pay taxes in June and September. So we're going to pick those up in June taxes, and September taxes are going to be that 25.3. And then we have the capital outlay. And that's going to be something that we're saving up for, that we're going to then pay, like buying a building or machinery in September. So that's going to be the 300,000 big cash outlay there for a capital investment. All right, and that's going to give us our total cash payments. And let's sum these up. I'm just going to use the sum function. Now note, I'm not going to sum up just the numbers here. I'm going to sum up the whole column so that we can then copy it across. And when we do so, it'll pick up the 300,000 when we copy it across to September. So I'm going to go in the sum. I'm going to say equals SUM, shift 9, up arrow, holding down shift, up, and then enter. So there it is. I'm going to copy it. Now I'm going to say Control C, right arrow, holding down shift, right, let go of shift, Control V, pasting it, double clicking, seeing that it does what we want. It is picking up the blank cells, but that's okay. Now, if these blank cells are bothersome to you, and they are bothersome to some people, they say you should have a 0 there. So you could go in and put a 0 there if that is, makes you feel better. It makes it so. And if you put a 0 down here, notice that then you have something. If I can put a little underline on it. So in other words, if I select these cells and want to go to the Home tab, font, and underline, then that little 0 at least provides something that has an underline in it. So then so if I put a 0 here, now we got an underline in it. So that's kind of nice. And so we'll just populate these items and then this item. So that looks good. And then we could double underline here if we like. So we could do that. That'll be nice. Home tab, font group, drop down, double underline. Let's go ahead and indent these items from labor down to capital. Let's go to materials to the capital outlay, because there's a colon here. So these are a subsection. So we'll go to the Home tab, alignment, and indent those. That's looking nice. That's really nice. Okay. So now let's go to the capital budget down below. So now we're going to, when we do the capital budget, notice we're not going to start with the beginning balance, then the change to the ending balance. We're going to start with the change, then add the beginning balance to get to the ending balance. So that's a little, just a little different than you might think of the order that it would go in. So just be aware of that. Not too bad once you get aware of it. And then we're going to have the other issue as a loan down here. If we actually dip below the minimum balance, and if we go above the maximum balance of 50,000, we're going to put that money into securities so that we can gain some investment on it as we accumulate it. Notice we're trying to save up for this $300,000 capital outlay in September. So our goal as a business usually isn't just to hold on to money, because if we have a lot of money and we're not using it, we can give it to the owner as dividends. But if we're saving up for some big outlay in the future, which is this $300,000, which we're really excited about because we think it could. But in any case, if we're saving up for something, then we may, hold on to that cash, of course, and then may want to put it into something like securities to try to get a return on it as we hold on to it to purchase something in the future. Okay, so what we're gonna do is we're just gonna take the inflows and outflows first that we got from our schedules. So the cash receipts are up top in our cash receipts schedule. So I'm just going to pick up the total cash receipts. And then we're just going to say this will be equal to the June cash receipts, bottom line of the cash receipts schedule. I can then copy and paste that. I'm going to say Control-C, right arrow, holding down Shift, right, Control-V. And that will just basically copy and paste with a formula format over here. You don't want to copy and paste and hard code it. You would like to have the formulas here so that if this schedule was to change, your budget would then change automatically. Then we're going to go down to the cash payments schedule, pick up the total cash outlays. Same process. This is going to be equal to the June outlays. Then I'm going to copy and paste it. Control-C, right arrow, holding down Shift, right, Control-V. And there we have it. Once again, you don't really want to copy and paste the hard-coded numbers because then you don't have a dynamic worksheet that will change as you change the inputs on the left-hand side. And then we want the cash flow, which is going to be the difference between the two. This will be equal to the receipts minus the payments, and then we can copy that across. Control-C, right arrow, holding down Shift, right, and Control-V, and there we have it. So obviously we're losing money in this area. We're gaining money, which is great, and then we have that big capital outlay, which is taking us down substantially over here. All right, and then we're going to say that we're going to be dealing with the beginning balance. Let's add the beginning balance now. And the beginning balance here that was given to us, and that would, of course, be the ending balance for the prior month. And that was, what was the beginning balance? Or the ending balance for May, which is the beginning balance for June, is given at the 21.5. Obviously, when we get to the ending balance for June, that'll be the beginning balance for July. So now we got to keep moving down with June here. So that's going to give us the cash balance before considering any loan or investments in the securities. Let's sum this up, equals the sum of these items, the 21.5 and the 8390, which is going to be subtraction because this is a negative number. So the 21.5 minus the 8390 gives us the 13110, even though we did that with the sum function. Let's put some format in here. Let's select these cells, put an underline there. Home tab, font group, drop down, underline there. Let's put an underline. I'm just going to select all the cells to put an underline on the whole row, even though we only have one number so far, which go to the home tab, font, and underline over here. And so now we've got the cash before the loan considerations. And then we have a loan if we need one. Now we don't have any loan that we need now because we are over the minimum of the 10,000. So we're good there. And then marketable securities is what we would purchase if we were over the maximum of 40,000 or 50,000. We're not there. We're in between the minimum and the maximum, so we don't need to do anything. So I could put a 0, on these items, and that's going to give us our ending cash balance, which is then going to be the sum of equals the sum of these items. Let's put an underline. I'm going to put the underline all the way across once again so I could format it even though I don't have anything populated there yet. So I'm going to go to the Home tab, Font Group, underline that. I'm also going to track down here once we have, if we do have a loan balance in the future, loan balance and securities balance, or the investment balance. Now we don't have any now, so the loan balance is of course 0 and the securities balance is 0. Okay, so then now this is going to be our ending balance. That's going to be now our beginning balance for July. So July is going to be equal to the ending balance will be the beginning balance here. We can then add these up, equals the sum of the 92.1 and the 13.110. Let's do that again. Equals the sum of these two items. So there we have it, the 105,210. So now we're not going to take out a loan, but now we're over the 50,000. So we want to put some of that extra money into the marketable securities to try to get a return, so that we have more money to pay off this 300,000 amount we expect to happen in September. So we're then going to say, all right, let's take, I want this to be a negative number. So, because it's going to decrease the cash flow. So I'm going to pick up this minus the 105,210, and that's going to give us our, a negative 55,210. And then if I sum this up, then if I say this equals the sum, that'll bring our cash balance down to 50,000. So we took out 55,210 to put into the securities investment. So nothing happened to the loan. Same items with the loan. So I'm just gonna put the formula there. But now we're gonna say, and I'm gonna say negative of, because I want to put the investment as a positive number down here. So I'm gonna say negative of that 55,210 is now what we have in the securities investment. All right, so now we're down to that balance of 50,000 because we forced it to be there because we put all the excess money into marketable securities. We're at the maximum balance, I should say maximum balance of the 50,000. That's going to be our ending balance for July and beginning balance for August. And then we can sum this up, equals the sum. And so we made some more money in August. That's going to take us over the 50,000 once again. So I want to put more money into the security balance, into the investment. So no loan needs to be taken out. And I'm going to do the same process here. I'm going to make this a negative number by taking the 50,000 minus the 109,530, and that's what we need to bring us down to 50,000. So this is going to be then equal to the sum of the 109,530 and that, which is going to be back to the 50,000. So once again, no loan was taken out, but we now have increased our securities investment, which is going to be equal to, I'm going to go to the left, and then I want to flip the sign here. So instead of saying plus this number, I'm going to say minus this number. Why? Because this is a negative, and so two negatives make a positive. So it's going to be the 55,210 minus a negative 55,530, which is basically plus. So we'll get adding them up. So in other words, we want a formula to add these two up is the bottom line goal there. All right, and then we're going to say that this ending balance of 50,000 is the beginning balance for September. And now we have this huge decrease because we paid 300,000 for this capital expenditure for like a building or equipment. So if I sum these up, then we've got this huge decrease now. So now what we're going to do is we're gonna sell the securities to cover, because that's why we've been invested in these securities to pay for this big outlay. So now we're gonna sell those. So that's gonna increase our balance here. So we'd have the 114,710, and then we're gonna most likely need a loan. So let's first sum these up and see where we are now, and then I need to bring the balance up to 10,000 in essence. So if I say this equals the sum of these items, I'm at a negative balance of 167,270. So I'm going to have to take a loan out for that. Plus, I'm going to need the added 10,000 because that's what I need in my minimum balance. That's our minimum balance that we want to have. So I could do that with a formula this way. I can say, okay, I want to then pick up the, say, equals. I want this 10,000, and I'm going to do it this way. I'm going to say minus, and then brackets, and the number above it, hold on a second, brackets. Oh, I put the wrong bracket. Brackets that way. And then I want to pick up this number plus this number. And then close it up. So that's what I need kind of algebraically. I can't use this number down here. Like you might say, well, why don't I just, take the 167,270 plus 10,000. I can't use this number in the formula, and I'd like to use this number. I'd like to have a formula. So what I'm going to do is I'm going to get to that number. I'll derive that number by taking the 282.10, which is a negative number, plus the 114,740, a positive number. So these two are going to subtract themselves out, and then take the 10,000 minus that, right? And that's going to give us our 177,270. So you can kind of mull that over. as to why that works. But bottom line is you want to make this sum be 10,000, right? And I'd like to do it with a formula here. I could plug in the number 177,270, but as much as possible, I would like to use a formula picking up the data on our data input sheet. And I cannot use the total down here, because if I was to use that total, just so you can see this, like you might say, you know, why don't I use this total down below before I entered it? You might have said, why don't I use this total down here? Well, if you use that total for a calculation like this, it's going to give you a circle reference. You'll get an error. It's going to say, hey, there's a circle reference. So, and that means you're trying to use this formula in a component in here, and then calculate on itself. And that's a common reference to have. So if you find a circle reference, that's probably what is happening. You're trying to get the sum, and then use that to calculate an input field, and you can't do that. So that's why we have to do this a little bit more complex formula to complete this out. Okay, so then we're going to say the loan balance now is at this 177,270, and we now have paid off the security. So this is going to be or we haven't paid it off. We cashed them in. So we have now sold the securities. So this minus the 114,740. So now we have no securities outstanding. We've got the loan outstanding, and we now have the minimum balance that has been reached from the loan after having that large capital expenditure, that balance at the 10,000.